Um, Welcome back to the next episode of the Investment Prospectus. So, in this episode, we are going to take a deep dive into the investment strategy and the investment universe. So, first part, we talked about the investment objective and the investment philosophy. Hopefully, you have a better understanding of each of these now, so that we can move on into the investment strategy. So, um, part of why we went through these firstly is because we use these as part of our strategy. So, how will you execute your objective using your philosophy? Um, so, basically, what an investment strategy is that it's a plan that guides your investing decisions to meet your financial goals while complying to your risk tolerance. Um, so it dictates the approach to asset allocation, whether it's conservative for wealth protection or aggressive for rapid capital appreciation. So, like in my last video, how I was talking about how I don't like to own more than 10 stocks at one time. That would be probably considered an aggressive approach when it comes to asset allocation because there's not too much diversification within my portfolio. The more diversification that you have in your portfolio, the more conservative your portfolio is because you have so many different factors in your portfolio that your capital will neither, grow rapidly or also won't decrease rapidly at the same time. The less stocks that you have in your portfolio, the more fluctuations you may see within your portfolio balance because you're taking on more risk having less companies in your portfolio. Um, but anyway, so yeah, so an investment strategy is a personalized plan that aligns with your financial goals and your risk tolerance. Um, I would say you should regularly review and adjust your strategy to adapt to you, your personal life events as well as market conditions as well. So your philosophy and your objective should really never see any changes to it. The only thing that should change when it comes to your investments is your strategy, the way that you're going about making your money. Um, But so like crafting an investment strategy, the things that you need to account for would be like your age, the goals, your lifestyle, your financial situation, the available capital or the available cash that you have to invest, personal situations, and your expected returns. Um, So kind of like in the last video, how I was talking about your age, your goals. So like lifestyle, like are you frugal? Are you a big spender? Are you shopping on Amazon all the time? Things of that nature. And then your financial situation, how much money are you bringing in per year? What are your bills looking like? You know, how much extra capital do you have after a month, like your monthly expenses and then your monthly income, things of that nature. And then available capital that kind of plays into financial situation, personal situation, so like family or your living situation. So somebody's sick in your family, you might not have the extra capital to invest your money at that time, type of thing. And then your expected returns. So you can't come into this thinking you're going to make a lot of money, but then invest your money into stuff that doesn't have the potential to make you a lot of money. So, on average, for like the past 50 years, something like that, the S&P 500 on average returned 8%. 7 to 8% per year. So that's kind of like the baseline expected return. That's kind of like what all the asset managers and portfolio managers, that's kind of what they use as like a baseline of, okay, we should be making at least 7 to 8% per year because that's what the historical trends have taught us is that historically we gain 7 to 8% per year. But that's also including the years that we dropped 20% or the years that we dropped 50% and the years that we jumped 30% and the years that we jumped 15%, as on average it's 7 to 8%. So, um, yeah, I would say investment strategies vary widely. There's not a strategy that fits everybody's plan. So what may work for one person may not work for you as well. That's why I think having your own ideas and your own foundation is important instead of just listening to what somebody else is doing because it might work for them, but you may not have that full understanding of how it's working for them. So if you just find your own strategy, your own philosophy, your own objective, it'd be a lot easier for you to understand how you're making money or maybe how you should switch up something or maybe how you should allocate somewhere else, those types of things. Um, so you should reevaluate and adjust your strategy over time to align with your portfolio and changing circumstances. So let's say your strategy is you're in a value investing. So you like finding stocks for cheap and then selling them at a premium. So let's say you bought a stock that was down, I don't know, 20% and it was 15% undervalued. And then within like 3 months, that stock is now up 20% from its lows and now it's undervalued by 5%. Now you use you used your foundation, your objective, and your philosophy to then decide if you either take your money and sell that stock or if you continue to hold that stock and then dollar cost averaging whenever the stock takes a dip in the future to then accumulate more shares, expecting the stock to continue to climb up from that point. Um, But yeah, you should always be reevaluating and adjusting your strategy. You shouldn't ever be changing your foundation because that's what holds you stable. Sometimes strategy that you're doing, maybe it's not working, so you start switching to something else. So like for example, my strategy right now is I use for my first video that Morningstar Investing Center tool and that Bloomberg Economic Calendar. So what I do every morning is I look at the Bloomberg economic calendar. I see what reports are coming out, and then I decide using all the information that's given to me from prior reports and current reports. I decide that whether I kind of decide like where we are in the economic cycle, and then I decide if we're in a good economic state or if we're in a bad economic state. If I think that we're in a bad economic state, then I will focus my portfolio more on safer assets. So like I'll start switching over to consumer defensive and then I'll buy a gold ETF and a bond ETF and then I'll just sit and wait if I believe that we're not in a good state. If I think that we're in a good state, and at the same time I'll also increase the amount of companies that I hold in my portfolio for more diversification, um, so that there's less risk of me losing a lot of money at one time. Now, if I believe we were in a good state, that's when I would restrict myself to 10 stocks at a time, keeping up with those 10 stocks, 10 companies I believe that will excel in the economic state that we're in right now. And then, yeah, um, but I would say the circumstance of the economy has a lot to do with your strategy. So I think if your strategy is ever going to change, it's going to be because of the state of the economy, which is why we use that Bloomberg economic calendar a lot, because then we can look at the history of the report and see how the report's been trending. And then we can kind of apply what we know to economics and everything else and come up with our own conclusion, our own way of thinking of maybe what path the market's going to take next. Um, I haven't really talked about economics at all on here. I would just highly suggest doing your own research on economics. I could probably do a video on like topics that I use quite frequently, which we could probably do that later on. I would say that's more advanced stuff. Right now, I'm just trying to get the basic foundation set up for you so that you have a true understanding of what you're getting yourself into. Um, but yeah, so um, so yeah, that's that. Um, and like part of your strategy as well as your time horizon. So your time horizon plays a factor into your strategy, and I would say that's because if you have a longer time horizon, then you have your strategy kind of changes a little bit because you can be more aggressive because you're not going to be selling um, as often as somebody with a shorter time frame. So you're not going to have to pay ridiculous amounts of tax on your capital gains. Um, so that would kind of change your strategy a little bit. Um, but yeah, so and then like shorter term, that would also change your strategy because maybe you're looking for, short-term momentum flips. You see a stock has dumped like 10% the past month. Maybe you buy in expecting that it bounces back a little bit and then you sell it. It's just like that. Nice little 8% gain, you know, something like that. I don't know. It's whatever you're feeling. But then you also have to, so that plays into a role of active versus passive. So, um, an active strategy is what I just explained, that little momentum play that you're looking for. So, an active strategy is you're always reallocating stocks. So, like, let's say that one of your stocks has jumped up a lot and it's at 15% of your portfolio now. So, you reallocate. That's kind of like being an active investor. If you were more of a passive investor, you wouldn't even touch that stock that's jumped a lot. You would just allow it to keep going. So like active investing is reallocating your investments to other areas. And like that kind of goes into the procedure manual here. I'm going to be dipping a little bit into the procedure manual, but like they recommend, so a lot of people recommend a 60/40 portfolio. So what that is 60% of your assets are in equities, or 60% of your money is in equities, 40% of your money is in bonds or CDs or, something that's a steady income. And then within that, 60% of equities and 40% of bonds, CDs, short-term capital, that sort of thing is you would have allocations of things inside of that. So maybe 30% of that 60% of money is in international stocks, and like 50% is in United States markets, ETFs, or, you know, if you're investing in individual stocks, if you're playing it that way. If you're doing a 60/40 portfolio, I would just recommend doing ETFs because if you're doing a 60/40 portfolio with individual stocks and with individual bonds and CDs, that's a lot of tracking you'll have to do. So I think just to simple it down a little bit, maybe if you're doing a 60/40, just ETFs. But anyway, so like you're reallocating these assets to stay within these limits. So in your procedure manual, you're going to decide what is what is like your comfortability of having, how much money are you comfortable with having in one company type of thing. So like we'll set a restriction on how much of a stock we can own in our portfolio at once. So you have a set of stocks. Each stock has a percent of the total value of the portfolio. So what is, so like let's say we have Microsoft, Apple, Nvidia. If Microsoft's 12% of our portfolio, Apple's 8%, Nvidia's 10%, do we maybe want to trim down those and spread them out across the board so that we take on less risk, or do we just keep that the way it is and maybe even taking capital from other stocks and putting more into them because they've been doing well, you know? So really it goes back to your risk tolerance. Um, so like as you can see, this all plays a role into one another. So that's why we're going over all this because it all plays a role into our investment and like the way that we think and the way that we go about things. Um, so that's like active and passive. And then passive is like you you just buy the stock and then you just don't touch it. And you're not reallocating your capital anywhere. You're just buying the stock, keeping it, letting, if it pays a dividend, letting the dividend drip, the dividend reinvestment, letting it compound over time type of thing. But also with active versus passive, and an active strategy, like reallocating all the time, you're going to be paying transaction fees and things of that nature. So just be aware of that. Short-term capital gains, you'll probably be paying on those as well if you made money on the play. So just know there's going to be a lot more fees with active than there is with passive, and fees can play a role into your overall return because if you're investing for long term, so like 20 years, if you're investing for 20 years, that's like part of your objective, and you're always selling stocks and buying other stocks, you're deteriorating your overall return because you've had to pay taxes and fees and things of that nature being an active investor for 20 years straight, you know? Whereas if you were just passive for that 20 years, you'd pay a lot less taxes because they'd be long-term games. You didn't have to pay those transaction fees or anything of that nature. So that, just keep that in mind as well as you go about this. And then set your expectations for how returns are generated. So basically what that means is like, how do you expect for you to make your money? Do you expect to capitalize on a stock that's been beaten down a lot and try to catch the bottom and try to take short-term gains? Or do you expect your money to be generated from buying a stock at a cheap price or what you believe is cheap and holding it for a long time, expecting the company to keep growing and to keep, bringing in cash flow, things of that nature? So just setting those expectations of how you're going to generate your returns, I think, is a pretty key role of your investment strategy. It's kind of like the foundation of your strategy almost, you know. But um, so now going into the investment universe. So in the investment universe, there's all sorts of things that you can invest in. You can invest in public companies on the stock market. You can invest in bonds. You can invest in U.S. Treasuries. You can invest in bond or U.S. bonds, U.S. notes. Um, ETFs, like you name it. There's so many different things that you can invest in. So when it comes to what I'm talking about specifically, though, it's mainly going to be ETFs and equities and stocks, things of that nature. Um, and then as well as like asset classes, going deeper into that, there are 12 different sectors. I think it's 12 different sectors of the market. So, for example, there's the information technology sector, there's the financial services sector, there's the industrials, there's um, real estate, there's, you know, whatever the rest of them are. That's just to name a few. Communication services. Anyway, there's different sectors, and certain economic indicators or economic events will affect different sectors. So, one economic event could affect all the sectors, or that one economic event could just affect maybe one or two, or maybe four or five. But that's where having an understanding of foundations comes into play, because then you can understand, okay, maybe this event could affect this sector because of this X, Y, and Z. So that's why getting into the nitty gritty of things is really good, because then you'll have more of an understanding of what may happen or what may not happen, which could, like, it can get confusing at times, but then you have to decide what the best possible action is, you know. So, um, so yeah, there's all sorts of different asset classes, um, and then like sector constraints. So for geographic, I mainly focus on the United States. I think you can't get any better than United States markets. You can, if you want to diversify, you can buy other countries' public companies as well. Now, it it's a little it can be a little confusing at times, but some platforms, some brokerages make you do other things to buy those assets, which is why I just stick with the United States, because it's nice and simple. But you can buy assets from other countries. Um, it's completely up to you. Um, and then there's also like ADAs on the stock market. So like they're listed on the United States Stock Exchange, but it's a company from another country, but it's listed as like a ticker symbol on the US Stock Exchange. So like for example, for Tencent Holdings, um, on the United States Stock Exchange, its ticker symbol is TCEHY, I think. But then on the Hong Kong exchange, it's like 700D, whatever. I don't know. But so yeah, so I mean, there are things out there that allow you to buy companies from other countries on the United States Stock Exchange, but then sometimes like those can be confusing as well, because then you have to put in like a limit order. There's just extra steps to it with some of them. So just keep that in mind. Um, and like I said, there's the different sectors and things like that. So why I like say like why I say I only work with like United States stocks and like stocks within like certain like I only hold 10 stocks at a time, but most of the time those 10 stocks are within the same sector. So like why having these constraints can improve your discipline is because if you can constrain yourself to certain things when it comes to investing, then you're going to be disciplined enough to know when to hold or when to buy more or maybe when to sell or maybe when to sell more, those types of things. So like setting those expectations or excuse me, having those constraints can improve your discipline, which discipline is very important when it comes to investing because you have to be disciplined to get results. It's like anything else in life. If you work out, you got to go to the gym consistently and you got to go hard consistently to get those results that you're looking for. Same thing can be applied here. You got to be consistent when you add money and you got to be intense when you add money. You got to really embrace all the knowledge and all the different possibilities that there are. So, um, and then I would say, so being over flexible, um, kind of going into that, you don't want to be over flexible when it comes to investing because if you become over flexible, you're going to kind of deteriorate from your objective and your philosophy and your strategy. So you can't be over flexible when it comes to things. That's why you have to have all these guidelines prior so that you can make repetition is probably the best thing in the market. Be like seeing things, seeing how they play out over and over again. That's probably the best thing for learning the market and kind of learning how things work within the market, how certain events affect investors' behavior and things of that nature. But being over flexible can get you into trouble because maybe you have too much allocation to one stock and then that stock takes a huge dip and then 15% of your portfolio just took a 50% dump. You're taking a big hit on your portfolio, you know? So like having these constraints and these restrictions on yourself kind of help you. They kind of guide you and also protect you from your future self. It like setting these things up protects yourself now from your future self making mistakes later because you're gonna keep that consistency, that discipline will help you in the end. But yeah, I think that's all I wanted to cover in this part. So we've now gone over investment objective, the investment philosophy, the strategy, and kind of like the universe of investments, the different asset classes and things of that nature and sectors. Um, and like I said before, I forgot to remind you, hopefully you're jotting down things for each of these of your own thoughts. Please do your own research. Do your own research on asset classes. Do your own research on sectors and geographics. How some countries' markets are more volatile than others and things of that nature. Um, just please do your own research on this stuff. Get a great understanding of it because having a good understanding of all this stuff will help you benefit you later on in your investing life. So yeah, thanks for watching and hope you enjoyed and leave any questions in the comments below. Thank you. Bye bye.